Welcome back to the channel. Today we're diving deep into a recent interview with Tom Lee, the legendary head of research over at Fundstrat, and one of the boldest voices on Wall Street. He sat down with CNBC's Squawk Box to talk markets, inflation, and where he thinks the S&P 500 is headed by year's end. Now if you've been paying attention, you know Tom Lee isn't afraid to go against the grain. This is the same guy who called for 5,500 on the S&P when we were still under 5,000. And now, with the market inching closer to 5,400 again, people are starting to take notice. In this clip, he breaks down why he believes investors are starting to get desensitized to the noise, why the recent pullbacks could actually be a buying opportunity, and what the latest inflation data means for interest rates, the dollar, and where to look for growth. Stick around, because right after I show you the full clip, I'm going to give you my personal reaction and a detailed breakdown of what Tom Lee really meant. Not just what he said, but how to interpret it in today's market environment. And most importantly, I'll wrap up the video with 2 high-conviction growth stocks that I believe are worth buying hand over fist based on the opportunities Tom hints at in this interview. These are long-term plays you'll definitely want to have on your radar, so if you only watch one video today, make it this one. Seriously, watch it all the way through to the end, because there's a ton of value packed in here. Before we jump into the interview, do me a quick favor. Smash that like button. Let's aim for 1,000 likes on this video. Share it with someone who's trying to navigate this crazy market. And if you're new here, hit that subscribe button so you don't miss the next big move. All right, let's hear what Tom Lee had to say.
I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah, and I think part of it is if someone had an investor hat on, not tactical hat, you know, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there. And the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks.
Interesting. So when we were below 5,000 and you were on the S&P and you were at 7,100, that's like 40%. So you're now, and were you one of the high people on the street at 7,100? Were you there?
Well, our year end originally was 6,600, but we thought we could touch 7,000 mid-year. I think the 6,600 is still possible, but I do think the 7,100 mid-year is obviously, it'd be very difficult to reach,
so
but it's possible.
6,600 by year-end. What about, you've made a lot of good calls based on moderating inflation. What did you make those numbers at the end of the week?
Well, I think that if we didn't have to consider tariffs, inflation is definitely tracking below expectations.
I mean, where the Fed wants it, almost. Right?
Yeah. I mean, core inflation month over month at 0.00056. I mean, that's like literally hitting a wall.
Now, is that for good reasons or for bad reasons?
I think it's for the right reasons because,
oil?
Yeah, well, there's oil and foods off the boil, but it really is shelter is actually cooling to a 2% rate, and that is what you need to get inflation back down to 2.
Do you, at this point, foresee the worst-case scenario in terms of dollar declines, 10-year yields due to people not... The Journal had an interesting piece today that it doesn't need to be that people just abandon the dollar and abandon the United States to invest in. It's just on the margin, because it's a given that you cannot ignore the United States is the elephant in the room globally for all these things, for the, the currency, investments. But on the margin, it could make a big difference if there was even a slight lessening of what we were used to.
Yeah, I agree. I think that is the narrative at the moment, that U.S. exceptionalism's over and people are selling treasuries and dollars to buy other assets. But I'm not in that camp that it's sustainable, because unless weaker dollar and higher yields suddenly makes the best companies in the world outside the U.S., the best and the most important companies in the world are American companies. They've produced the best shareholder returns. And if you look at the S&P, 40% of the returns of the S&P come from new companies every 10 years. Is there going to be suddenly the best new company coming out of Europe instead of the U.S. because of the dollar? And I doubt it. And I think U.S. companies are going to adapt.
All right, let me break it all the way down for you, line by line, and give you my take on what Tom Lee is really saying, what he's predicting for the markets, and why it matters to you as an investor. Whether you're new to the stock market or you've been in the game for years, this breakdown will help you understand the big picture Tom's painting and what kind of moves you might want to consider based on his outlook. So let's start with the headline. Tom Lee is still bullish, very bullish. This is the same Tom Lee who, earlier in the year, made what many thought was a wild call that the S&P 500 could hit 5,500. Back then, the index was trading below 5,000, and most people thought he was being overly optimistic. Fast forward to now, we're knocking on the door of 5,400. That's a huge move. And Tom Lee looks a lot less outrageous today than he did a few months ago. And what's really interesting is how calm and collected he is about this prediction. He's not rattled by the recent volatility or the headlines about tariffs and global tensions. In fact, he compares the market's reaction to bad news to a cat that gets used to loud clapping. At first it jumps, but eventually it doesn't even flinch. That's such a great analogy. What he's saying is that the market is becoming desensitized to fear-driven narratives. All the doom and gloom, it's starting to lose its punch. Now, one of the big data points he brings up is the percentage of stocks trading below their 200-day moving average. He says that number recently dropped to just 15%. Historically, when we see that kind of setup, where so many stocks are beaten down, it actually ends up being a strong buy signal. That's classic contrarian thinking. When everyone else is scared, that's when the best opportunities start to emerge. He also mentions the VIX, the volatility index, which recently spiked above 50. And again, based on historical trends, Tom believes that when the VIX is that high, it's often a great time to buy, not sell. Why? Because fear is peaking, and when fear peaks, stocks tend to be undervalued. So while the market has been choppy, full of zigs and zags, as he puts it, Tom Lee believes the underlying story is still unequivocally positive for stocks. He's not fazed by the noise. In fact, he sees opportunity in it. Let's talk about his price targets. Tom originally had a year-end target of 6,600 for the S&P 500. That alone is super bullish. But at one point, he thought we could even touch 7,000 or 7,100 by mid-year. That's like 40% above where we were when he made that call. Now he's backing off that mid-year 7,100 level a bit, saying it'll be difficult to reach. But he's holding firm on that 6,600 target for year-end. That's still a bold prediction, especially considering the macroeconomic headwinds we're seeing. But the thing is, Tom doesn't make these calls blindly. He's basing a lot of this on one critical theme. Inflation is cooling. Now here's where it gets really interesting. Tom zeroes in on the most recent inflation data and points out that core inflation is tracking way below expectations. He even throws out a month-over-month number of 0.0056%, basically flat. That's huge. Because if inflation is stalling out, the Fed may have no reason to keep rates high for much longer. And he emphasizes that the drivers behind this cooling inflation are legitimate. Not just temporary drops in food or oil prices. He specifically says that shelter inflation is cooling to about a 2% annual rate. And that's key, because shelter rent, housing, etc. is one of the stickiest parts of the inflation basket. If that's softening, then inflation overall has a real shot at coming back down to the Fed's 2% target. This is one of the major pillars of Tom's bullish thesis. If inflation continues to ease, the Fed can pivot or at least stop tightening, and that gives stocks room to run. But not everything is sunshine and rainbows. There's a little shadow here, and that's the renewed fear of tariffs. There's some political noise about trade tensions flaring up again, and naturally people are starting to talk about the dollar, yields, and what it all means for capital flows. One of the interviewers brings up a piece from the Wall Street Journal suggesting that investors might start pulling money away from U.S. assets, not in some catastrophic way, but just on the margin, and that even a slight reduction in foreign appetite for U.S. treasuries or the dollar could have a big impact. Tom doesn't fully buy into that theory. He acknowledges the narrative that maybe U.S. exceptionalism is fading and investors are shifting abroad. But then, he hits back with a powerful counterpoint. The best companies in the world are still American, period. He points out that 40% of the S&P 500's gains over any 10-year period come from new companies, the next wave of innovation. And historically, it's U.S. firms that create those market-leading breakthroughs, so even if the dollar weakens or yields rise, Tom believes global investors will still come back to the U.S. because that's where the growth is. So, here's my take. Tom Lee's interview wasn't just another bullish rant, it was a calculated, data-driven defense of why he still sees huge upside in the market, even with all the noise. He's calling out opportunities when others are panicking. He's seeing past the volatility and zooming in on fundamentals that actually matter, like inflation, innovation, and earnings growth. Now, of course, no one knows the future, but Tom Lee has a solid track record, and he's earned the benefit of the doubt. His message is clear: stay focused, don't get distracted by the short-term zigzags, and keep your eye on the bigger picture. If you're a long-term investor, this interview might give you a little more confidence to stay the course or even double down when others are fearful. Anyway, that's my breakdown of the interview. Let me know what you think in the comments. Do you agree with Tom's outlook? Are we heading to 6,600 by year-end? Or do you think he's being too optimistic? Smash that like button if you found this breakdown helpful, and don't forget to subscribe for more market commentary and investing insights like this. Now let's dive into the two explosive growth stocks to buy hand over fist this year. These are companies that are at the forefront of innovation and industry leadership. We're talking about a leader in the metaverse and social media, a pioneer in programmatic advertising, and a giant in the digital advertising world. First up, we're diving into the world of Meta platforms, formerly known as Facebook. This is a company that has undergone one of the most significant transformations in the tech industry, rebranding itself to reflect a bold new vision for the future. Now, I know what you might be thinking: Meta? The same company that's been at the center of so many debates about privacy, data, and social media's role in our lives? Yes, that Meta. Haven't they had their ups and downs? Absolutely. From regulatory scrutiny to public perception challenges, Meta has faced its fair share of hurdles. And yeah, sure, every company has its moments. But what sets Meta apart is its ability to adapt, innovate, and push forward despite the challenges. But here's the thing: Meta is not just Facebook anymore. It's a tech giant with a portfolio that extends far beyond social media. They're pouring resources into the metaverse, a whole new frontier of digital interaction. This isn't just a buzzword, it's a vision for a future where the lines between the physical and digital worlds blur. Imagine a world where you can work, play, and connect with people from all over the globe in a completely immersive digital environment. Virtual reality, augmented reality, and advanced AI are all coming together to create this new reality. That's the vision Meta is building towards. It's ambitious, it's futuristic, and it's unlike anything we've seen before. And let's not forget about their social media dominance. Facebook, Instagram, and WhatsApp are still some of the most widely used platforms in the world. These platforms have billions of active users, generating massive amounts of data that Meta leverages for its highly targeted advertising platform. This is the engine that powers their revenue and fuels their innovation. But here's where it gets really interesting. Meta isn't just resting on its laurels. They're making significant strides in artificial intelligence and e-commerce. AI is at the core of their operations, from content moderation to personalized user experiences. And when it comes to e-commerce, Meta is integrating shopping experiences directly into their social media platforms. Imagine discovering a product on Instagram and purchasing it without ever leaving the app. Now, I know some investors are hesitant about Meta. The metaverse is still in its early stages, and there are concerns about competition, regulation, and the sheer scale of their ambitions. The tech landscape is competitive, and Meta faces challenges from other tech giants and regulatory bodies. But that's the nature of innovation. It's not without risks. But here's the thing: Meta has a history of innovation and adaptation. They've shown time and again that they can pivot and thrive in changing environments. They've faced challenges before and emerged stronger. Whether it was the shift to mobile or the rise of video content, Meta has consistently found ways to stay ahead. Remember when everyone thought mobile would be the end of Facebook? Critics doubted their ability to adapt, but they proved everyone wrong. They pivoted, embraced mobile advertising, and look at them now. They're a mobile advertising powerhouse, generating billions in revenue. Their ability to adapt to new trends and technologies is one of their greatest strengths. The point is, Meta is a company that's not afraid to take risks and push boundaries. They're willing to invest in the future, even if it means facing uncertainty. They have a bold vision for the future, and they're putting their money where their mouth is. This isn't just about profits, it's about shaping the future of how we interact with technology. And with their massive user base, unparalleled data collection capabilities, and commitment to innovation, I believe Meta has the potential to be a major player in the metaverse and beyond. Now, let's talk numbers for a second. Meta's financials are strong, and their revenue continues to grow year over year. Their earnings are impressive, and they have the resources to fund their ambitious projects. They have a strong balance sheet and generate significant cash flow, which gives them the flexibility to invest in innovation. Meta is with a massive market cap of $1.38 trillion. In 2024, Meta brought in a staggering $164.5 billion in revenue, with an impressive net income of $62.36 billion. That's not just solid, that's elite performance. Its earnings per share stand at $24.59, and it's trading at a PE ratio of just 22.11. That's pretty attractive when you consider the kind of growth and profitability Meta consistently delivers. Even more interesting? Meta has started paying a dividend, currently sitting at a yield of 0.37%. That might seem small, but for a company that's known for plowing capital back into innovation and growth, it signals a new phase of maturity and shareholder returns. Of course, no investment is without risk, and it's crucial to do your own research and consider your investment goals and risk tolerance. The metaverse is a long-term play and patience will be key. But for investors looking for exposure to the metaverse, social media, and the future of digital advertising, Meta Platforms is definitely a company worth considering. Their vision is bold, their resources are vast, and their potential is undeniable. Now let's move on to our second growth stock, The Trade Desk, ticker symbol TTD. This company is revolutionizing the advertising industry, redefining how businesses connect with their audiences in a digital-first world. And they're just getting started, with a vision that extends far beyond the current landscape of digital advertising. So, what exactly does The Trade Desk do, and why are they so pivotal in this space? In a nutshell, they're the leading independent platform for programmatic advertising, a field that's transforming the way ads are bought and sold. Now I know that might sound like a mouthful, but stick with me here, because this is where it gets really interesting. Programmatic advertising is all about using technology to automate and optimize the process of buying and selling ad space. It's a game changer for advertisers. It's about targeting the right audience with the right message at the right time, all in real time, ensuring maximum impact and efficiency. And The Trade Desk is the best in the business at it, offering tools that empower advertisers to make smarter, data-driven decisions. Think about it. Traditional advertising is like trying to hit a moving target with a blindfold on. It's inefficient and often wasteful. You're throwing money at billboards, TV commercials, and print ads, hoping that some of it reaches your target audience. But there's no guarantee. With programmatic advertising, however, you're using data and technology to laser focus your ad spend, ensuring every dollar works harder for you. You're reaching the people who are most likely to be interested in your product or service based on their behavior, preferences, and demographics. And you're doing it in a way that's measurable and accountable, with clear metrics to track performance and ROI. The Trade Desk provides a platform that connects advertisers with publishers, creating a seamless ecosystem for buying and selling ad space. This allows advertisers to access a vast network of websites, apps, and connected devices, reaching audiences wherever they are. And here's the kicker. They're platform agnostic, meaning they don't own any content or media themselves, which is a huge advantage. This neutrality allows them to be completely objective in their recommendations, focusing solely on what's best for their clients. They're not trying to push their own inventory or prioritize certain publishers, which builds trust and credibility with advertisers. Their only goal is to help advertisers achieve the best possible results from their campaigns, and their track record proves it. The results speak for themselves. The Trade Desk has consistently outperformed the industry, delivering impressive revenue growth and profitability. Their financial performance is a testament to their innovative approach and the value they bring to their clients. They have a strong track record of innovation, constantly pushing the boundaries of what's possible in digital advertising. From cutting-edge technology to new features and capabilities, they're always staying ahead of the curve. But what really excites me about the Trade Desk is the massive market opportunity ahead of them, as the digital advertising space continues to grow. Programmatic advertising is still in its early stages of adoption, with plenty of room for growth and innovation. And the Trade Desk is perfectly positioned to capitalize on this growth thanks to their leadership and expertise. As more and more advertising dollars shift from traditional media to digital channels, the potential for the Trade Desk is enormous. The Trade Desk is poised to become an even more dominant force in the industry, setting the standard for programmatic advertising. They have a proven business model, a talented leadership team, and a clear vision for the future. Their relentless focus on innovation ensures they'll continue to lead the way in this rapidly evolving industry. With a market cap of $24.7 billion, it's not trying to be Meta. But what it lacks in size, it makes up for in specialization and agility. In 2024, the Trade Desk reported $2.44 billion in revenue and a net income of $393.08 million. Its earnings per share is 79 cents, and while it trades at a much higher PE ratio of 62.63, that premium is largely a reflection of its high-growth profile and leadership in programmatic advertising. This is a company that's disrupting how advertisers reach consumers in a cookieless, privacy-forward world, and it's doing it at scale. For investors looking for exposure to the high-growth world of programmatic advertising, the Trade Desk is a stock you can't afford to ignore. With their innovative platform, strong market position, and massive growth potential, the Trade Desk is truly the undisputed king of programmatic advertising. So there you have it, folks. Two growth stocks with the potential to supercharge your portfolio, Meta Platforms and The Trade Desk. These are not just any companies, they are trailblazers in their respective industries, setting benchmarks for innovation and growth. Meta Platforms, with its dominance in social media and virtual reality, is shaping the future of digital interaction. Meanwhile, The Trade Desk is revolutionizing the advertising industry with its cutting-edge programmatic solutions. Both companies are poised for massive growth, driven by innovative strategies and expanding market opportunities. But remember, investing is not just about picking stocks, it's about building a strategy that aligns with your financial goals. If you're looking for exclusive stock tips, in-depth analysis and actionable insights, real-time trade alerts and free investing guides, then you're in the right place. Join the StocksGalore Patreon today. Our members gain access to detailed breakdowns of stocks, market trends and strategies to maximize returns. By becoming a member, you'll also connect with a growing community of like-minded investors who are passionate about achieving financial freedom. Head over to patreon.com/StocksGalore to join today. The link is in the description below. Remember, investing is a journey, not a sprint. Always do your own research, and take the time to consider your personal investment goals and timelines. Assess your risk tolerance carefully before making any decisions. A well-thought-out plan can make all the difference in achieving your financial aspirations. Don't forget to share your thoughts in the comments below. We'd love to hear your take on these stocks or any others you're watching. And of course, hit that subscribe button to stay updated with all our latest videos. Let's grow together.